And writing my initial talk today, I realized that a year ago today was when we've been hosting this event for actually 15 years, and it was a year ago today that we said farewell to our president of 19 years, Bill Spencer, at this exact luncheon, and began a new era. And Bill's here today. It's been a great year. We hosted our 15th annual HBCA Entrepreneur and Deal of the Year, where we had over 200 attendees, had 7 awards and an achievement award. So it was a huge event, and amazing that we could give out so many awards, and there were just so many options. Actually, that's a great thing to have. And we had 3 finalists per award, and it was a really difficult decision made by our selection committee based on the nominations that we received. So that's a huge, it's just amazing that we just have so much activity going on. So thank you, everyone. With that, we've also had some amazing luncheons and events happening. We had our new investment innovations. We had an event on broadband. We had a luncheon, which was the final gubernatorial debate before the election, focused on what each candidate would do and support innovation. We have the legislative agenda for 2015 to get a handle on the programs and initiatives that affect the future of the innovation economy in Hawaii. We also had a special event, Growing Hawaii's Innovation Economy, where HBCA hosted the annual Best Practices Symposium with support from the High Growth Initiative and the Hawaii Business Roundtable. So again, just an incredible, fun-filled year over the past 12 months. So very excited for these next 12 months as well. So with that in mind, I'd also like to thank everyone for their support of our organization and attending our monthly events. And I want to especially thank our members. So today, HBCA, our annual venture capital luncheon. What's going on here? So normally Tim Dick does a short presentation, and he'll be doing one today on angel and venture capital market for 2015. So I'd like to invite Tim Dick to the stage.
Thanks, Melly. Thanks, everybody, for being here. I'll get the slides up in just a second. So every year I do this. Maybe we missed last year. And it's always interesting to sort of crunch through all the numbers, all the statistics, and there are a lot of them. It takes about 50 or 60 hours to put this together. And see what the messages are. What happened in the industry, what's going on in the industry, where is it going, where has it been, and so forth. So it's always a fascinating exercise going through these, because there's all kinds of aha moments. And this year there's something really, really big, which I think will give us quite a lot to talk about, probably the panel afterwards. Presentation will be available on SlideShare. Melly, I'll send you the link later on. So for those of you who haven't been put to sleep, you can look at it later. And let's kick it off. Let's click it off.
Click it off.
Okay. So this is the cycle. Most entrepreneurs think that venture capitalists just have money, they just have, but no, we have to go out and raise money too. And we just finished raising our second fund, which is great. Very happy to have that complete and just be focused on investing in you guys rather than panhandling ourselves. We then invest in startups. We invest in you. Startups exit, we hope, right, in a good way. And we then return money to our investors, the LPs. That's the circle of life. They then theoretically invest back in us, and the circle begins again. So we're going to look at all these phases today. The first one is where it all starts, right? These are the LPs, the big institutions, the pension funds, and other kinds of things, family offices that invest in institutional funds. So this gives us a chart that goes back to 2000. You can see the end of the dot-com boom there. This is the monies that were invested by limited partners into venture capital in the United States. And as you can see, we're pretty close to post-dot-com high here. Down a little bit, I think in the first quarter of last year when we annualized that, but still a very, very healthy clip. We're running about $35, $40 million, $1 billion, I should say, invested into venture capital funds. The number of funds raised increased. So that means obviously if you do the math, the average fund is a little bit smaller than it was last year. More funds raised, same dollars in, a little bit less per fund. New funds raised as opposed to follow-on funds exceeded 30% for the first time. So there's an inclination, a leaning in the LP community for a little bit more risk, right? So you're betting on a team that's unproven as opposed to investing in, say, Kleiner 12, for example. Not much team risk there. So obviously on the fundraising side for VCs, a very healthy market. Not too hot. We don't want it to get too big because we saw what happened in 2000 when too much money goes into the industry. And we'll see some of the effects of that in the next few slides. Let's talk about something that's more interesting to you guys. Oh, venture capital continues to return well. That's important to our LPs. If we don't produce good returns, they don't even invest in us, and we can't invest in you. So that's nice to see. All right, venture capital investing industry. You can see the big spike. That's dollars going into startups from VCs. That's obviously 2000. So we can see that the present trend, almost $50 billion of venture capital going into startups, is at a post-dot-com high. What's interesting is how small of an asset class is. Venture capital is the smallest recognized institutional investment class. All of VC on a post-dot-com high is less than 1/4 of Apple's revenue. That's how small of an asset class it is. It's a very specialized asset class. It's not for 99.99% of the companies that are out there. But having said that, for venture capital, this is a healthy time. Corporate VC, we're seeing exactly the same trend. It's at a post-dot-com high. And this is always a little bit concerning in some ways. When you start to see all kinds of corporations getting into venture, you start to worry about whether there's going to be, maybe too much money going in for the quality of startups. So something that's sort of a barometer of where we are in peakiness. Well, what's interesting is the number of venture capital deals invested since the dot-com bubble has been essentially flat for 15 years, 3,000 to 4,000 deals a year. So no more companies are getting invested in, right? That's kind of an interesting fact. So the number of companies that venture capital funds have actually invested in over the year, they haven't found more places to put money. They're not investing in more companies. So that's just sort of an interesting measure of activity in terms of whether this asset class is going on. There are more startups that are actually getting funded. The answer is, for the most part, no. About 4,000 were invested in last year. This is pretty amazing. Silicon Valley and California put together is over 60% of the venture capital dollars going in. Silicon Valley by itself is almost 50% of the dollars going in. So instead of what we thought would happen, that venture capital would democratize and kind of go across the country, exactly the opposite has happened. This is really pretty surprising to us because I think for those of us that are based out of Silicon Valley, we felt that this would actually happen, that it would go the other way. And there were real signs of that. When New York got hot and other kinds of things like that, those markets are still there, but the pendulum has really swung back more to Silicon Valley than at any time than the mid-1990s. This is kind of shocking to us. It's good if you're in the valley, right? We get to see lots of deals. We get to see tons of deals. But it's not good if you're outside of the valley. Where are the dollars going? Software is eating the world, as Mark Andreessen said. And that's certainly true. It's almost 50% of the dollars going in are going to software deals. And when you look at the sort of internet and consumer side of things, it's really shrunk. Internet plus consumer plus mobile combined is now less than 10% of the deals. So that whole consumer bubble is really gone. And it's going in much more into actual software technology companies. Biotech is down to 10% on this, and this is on a deal-by-deal basis, not a dollar. So you're seeing the same trends in deals as you are in dollars. So the same thing that we're seeing in dollars going in is reflected in the actual number of deals being done, right? And so those are different. Where the dollars are going, where the deals are getting done, can sometimes be different. But in this case, we're seeing they're not. Software is really eating the world. Biotech is still number 2. That's right down at the bottom in this list. And what's kind of interesting is energy and industry is bouncing back a little bit. Because that was very, very much out of favor after the solar bust and the subsidies ending and so on and so forth. So that's actually coming back now without the subsidies that were occurring in the middle of the last decade. Right? So that's kind of a healthy sign that the costs of those technologies are starting to become attractive enough to invest in without the subsidies that we saw previously. This is really interesting. Look at the bottom of the blue bar. That's seed and startup stage capital. First stage out of angel. It's being crushed. And these are the actual rounds. These are not dollars going in. These are actual deals being done. Early stage, so Series A, that would come sort of after where we invest, is really ballooned. So, for us, for me as a fund, selfishly, that's great. And we are seeing this. We are facing very little competition in terms of the Series seed stage deals, 1 to 3 to 4 million that we're seeing. We've got our pick of the litter right now, and very little competition. For companies that want to follow up for us, there is a feeding frenzy, which again is terrific for our companies and our investments. Our first investment last year in second fund, PlayFab, we had a proactive offer on the table from Benchmark 5 months. We were done in 5 months. We had the offer on the table 4 months after we funded that deal. And it was a feeding frenzy. So terrific for the option. It's a great company, so I don't want to minimize the fact that it's a great company and a great entrepreneur. 20 years of experience in the gaming industry. But this is a challenge for companies that are just coming out of the angel stages. There's very little deals being done. There's very little dollars going in here. So this is kind of a bummer for folks that are at the early stage. Later stage are healthy. You don't worry too much about those. The good deals are going to continue to be good, and that sort of bounces around less than the seed and the Series A. Let's look at the deal sizes. These are dollars going in. And so there you would see a little bit more of what you would expect, that the startup and seed stage deals have actually gotten a little bit bigger. They're starting to look more like the average Series A now, because there are less deals going around. Series A, you're seeing $5, $6, $7 million averages. Expansion deals have gotten much bigger, as have late stage deals. And part of this is driven by some of the $1 billion deals and the $100 million deals, names like Uber and so forth, that do distort the market. I didn't have time to pull those actual individual deals out of this and see what those numbers look like, but those deals are so big that they do distort the actual average round size upwards on the expansion and later stage. And I would guess if you take those deals out, they probably look much more like this for a real average deal. The decacorns, right? Not the unicorns, the decacorns. This is about an all-time high, probably post.com high. 79% of the rounds were done up rounds. That's pretty awesome, right? And only 6% were actually down rounds, which is really a sign of a very enthusiastic market here. So, I guess the news is once you're in the club, once you are funded, your chances of getting a follow-on and your chances of that follow-on being up round are pretty good. Software and internet media had the greatest percentage of up rounds. Life sciences always tend to lag that because it is so driven by whether you make your hard science milestone or regulatory filing or not. It's up or down, in or out. There's very little grayscale on those. Clean tech, the two on the right, clean tech and other, there were only 2 deals in each of those categories. So I wouldn't pay too much attention to those. It's not enough to be statistically significant. but the rest does tell you that software, internet, and digital media do tend to have the greatest chances of up rounds. They're the ones that are most driven by execution risk as opposed to actual regulatory or other kinds of hard milestones that can bring them down. And the round-around price increases are really remarkable. So if you look at the numbers, those percentages, that's what is the price increase, the average price increase between, say, the Series C and the Series A. Now, if we look at the top bar, that's Series B, so that's a Series A to a Series B. The average up round increase is 192%, so almost a 2x up round. So that's a pretty healthy number, probably again a post.com high in terms of round-to-round price increase. As you would expect, as you go down the series, that drops a little bit. But Series E, when you start to get to Series E, Series F, those things, you are starting to look at a substantial portion of those that are recaps. So it's not too surprising that round-to-round increase is an average of about 37%, because that's pretty long in the tooth for most companies by the time you get up to Series E, Series F. Very, very, very healthy market. And the bullish sentiment is echoed by some of the measures of things like liquidity preferences and so forth. When the market is really bullish, everything is going up, people don't worry about liquidity preferences too much, and that's at 19%. Okay, so I'm not going to spend too much time on this, but it is at a really high level. I think it's a healthy level. It's probably at the top end of the healthy range before you start to get a little bubble-icious. But everything is looking pretty rosy in terms of being able to raise venture capital right now. If you have a good company, you're probably going to get funded right now. All right, let's look at angels. Angel funding, also at the highest level since the dot-com boom. 1.65 billion invested in 870 deals. And the statistics you're about to see are mostly from the Angel Research Institute and the Halo report. So that does capture, Shanoa, you would probably say that this captures most of the deals, the tech deals, because there's obviously a lot of non-technology angel deals. The deal size and valuations are terrific. But what's really interesting is there's a real disconnect in where the dollar's going in angel rounds and where they're going venture capital. This was the big surprise for me. So let's talk about crowdfunding first. It's still dominated by project stuff like Indiegogo and Kickstarter. If you look at the numbers there, $1.4 billion has gone into Kickstarter projects over the past few years, since it started probably 4 or 5 years now. AngelList, $100 million has gone into AngelList deals via AngelList since more or less inception. That was really surprising to me because it's obviously a very popular platform and so on and so forth. And obviously, I think it is growing, but it does explain why they're moving into funds a little bit more, because the absolute dollars that are going into this are pretty small. But I'm hopeful that this kind of platform will continue to grow and to make that angel market more efficient. The SEC is still basically silent on the unaccredited investor crowdfunding, and the issue that they continue to grapple with and have not found a solution for is the principle of adverse selection. In other words, the deals that wind up on that market are the deals that can't get the smart money, the dog magnet problem. So we'll see where that goes. I think it's really going to be tough to get around from a practical perspective. We'll see what happens. So here's the Tech Angel round size. You can see huge hockey stick in 2014. Average Tech Angel round size 1.64. The median round size 0.8 million, so 800,000. So really, really healthy numbers here. And the tech round sizes are up across all of the sectors: left, healthcare, center, internet, and on the right side, mobile and telecom, which is 95% mobile applications. And the valuations are at all-time high. We're seeing a median of $2.5 million last year, up to a median of $3 million this year. So that's pretty darn good for a price point for an angel stage deal. Now, obviously, there are many deals that are not priced; they're notes. But this would reflect things like prices and conversions and other sorts of things like that, where there are prices that are set. And I apologize for going really fast on this because we've got some important stuff to talk to you in a minute. As in the past few years, the angel monies are spread relatively evenly with the population of the United States. The dollars are local for this, which is obviously very different from where the dollars are at the venture capital markets, right, which are really concentrated 60% in California. So that obviously has implications in terms of the old saw that a VC won't invest in a company that they can't drive to in 45 minutes. And there is some truth to that. Angel investing, these are the segments, and as you can see, they haven't changed very much. So we look at the bottom, this is internet, so kind of consumer internet deals, healthcare is green, industrial, mobile and telecom is up here, so that would be things like mostly mobile internet kind of plays. And mobile and internet plays are kind of a little blurry because they're pretty similar, right? So you can kind of lump those together in sort of the consumer sector. Above that, industrial, food and beverage, and then finally 20% other. So you can see that the preferences for angels in terms of the sectors they like to put money into hasn't changed much since 2010. But guess what? That's really different from where VCs put their money. And that's really important if you're looking for follow-on money. So VCs are, so we've got venture over here. We've got angels over here. So biotech and healthcare, it's pretty similar, right? Both, 20%. Industrial and energy, about the same, about 4%. But the landslide of the angel dollars, almost 60% are going into consumer, mobile, and media. Less than 20% of the venture dollars go there. The VCs are putting their money in software, but angels are not. So this is a huge market discontinuity. It's ginormous. What it really says is that in most cases, VCs are not investing in the deals that angels are doing. And I think we should talk about that, because this is like, I was sort of dumbstruck when this just sort of leaped out of the page. It's like, this is a huge problem. I'm going to move quickly. We've got a panel.
Define software, please.
Software is defined as stuff like cloud applications that are business to business. Think Salesforce, think NetApp, think AWS, those kinds of things. Non-consumer facing stuff, right? Tech-driven as opposed to a web app like a SlideShare, for example.
Thank you.
And so we can spend some time talking about this, and I really spent a bunch of time sort of mulling on this, and this just sort of kind of hit me a couple of days ago, so it's still new to me. There's lots of reasons why this might be happening, and probably combinations of them and so forth. Consumer-facing deals, everybody can understand it, right? We all know what this app does. There's like, I get it. Okay, I'm in or I'm out. It may be proportional to the applicant pool. More apps and consumer stuff are being developed than software. Consumer internet has a lot lower technology barriers to develop something than actual hard software. Angels may be less aware of the venture capital funding patterns. We're fixing that now. And consumer IPOs obviously have headline making news in the general media, Twitter, Facebook, all these things, versus the broad exit market of companies we've never heard of, most of which, 7/8 of which go out as M&As. Those just don't make the news, so you're not conscious of it, right? So let's take a look at exits. IPOs, the blue line at the bottom, M&As at the top. First thing that leaps right out is a lot more M&As than IPOs, as you would expect. Typically, on average, about 6 to 7 times more acquisitions than IPOs. Both are at very healthy levels. So you're looking at, on an annualized basis. This is quarter by quarter numbers. So last year, something like 90 IPOs went out, and well over 1,000 M&As happened. And it looks like we're on trade. Maybe we're a little bit down, but Q1's always a little bit off. we're probably on track for a similar number this year unless something awful happens in the economy. And the valuations remain terrific. So I've highlighted in the IPO, the blue line here at the top, 2011, that there was a big distortion from Facebook, Groupon, Twitter, and Zynga all going out. A number of those are down on their original numbers, as you know. And then in 2014, that number is distorted on the M&A side by Facebook acquiring WhatsApp for almost $20 billion. So that's enough to sort of skew the number there. If it wasn't for that number, I think it's probably the average around $200 million in M&A, so up a little bit over the long-term average, about $150 million for the typical M&A. And that's kind of it. So there's the round numbers. VCs put about $50 billion into investments. We returned about $100 billion in exits last year, and LPs put $30 billion back into us, which isn't exactly balanced. So we need the LPs to get on the program and write us some more checks. Otherwise, we're going to have to cut our checks next year. And we can talk about this sort of during the panel here. Because we've got to figure this out, right? Why are the angel networks investing in such a different pattern than the venture capitalists, which we're all dependent upon to take those companies to the next stage? So, okay, that's it. Oh, I guess the last piece of that is, looking at the constancy of 5 years of the angel investing versus where the VCs are going. The angels aren't changing what they're investing very much, whereas the VCs are, because the VCs are looking at, I want to invest where the exit markets are good. So the VCs are moving around with the technologies, the angels are not. Another kind of interesting observation. That's it.